Welcome, everybody. This is the Build Asset Management Weekly Roundup for the 28th week of 2025. It is approaching mid-July and starting to get pretty steamy out all across the country. I'm Dave Martin, COO of Build Asset Management. I'm filling in as host for Cameron Otsuka, who's still enjoying some vacation time. I believe he's somewhere in an undisclosed location in the North Atlantic Ocean. So maybe he can fill everyone in on that. I've got Matt Dines, co-founder and CIO of Build Asset Management with me. How's it going, Matt?
I'm great. Things just keep happening. There's always something new to talk about every week, so it keeps us busy.
So much to talk about. Well, speaking of talking about things, Matt, I saw the news across the wire here that you have been invited to speak at Bitcoin Asia in Hong Kong on August 28th of this year. Congratulations. That's pretty cool. What are you going to talk about?
Yeah, thank you. I'm excited to go to Hong Kong, represent Bitcoin and American business, I think, especially on the fixed income, credit, and lending side of Bitcoin, to, I guess, reach across the Pacific as everything's changing with the relationships of international trade, macro, geopolitics, et cetera. So it'll be fun to, this will be my second international conference I've spoken at with BTC Inc., the conference organizer, and I'll get to see a new part of the world. I've been to, Asian countries, Tokyo in particular. Really enjoyed it. But this will be a new chance for me to see Hong Kong. So really excited to see what's happening. As far as what we'll talk about, it'll be, big picture. If you've been following the weekly roundup, we talk about things like the Hong Kong dollar, the US dollar peg that's operated by the global money center scale financial institutions that operate out of Hong Kong, and the specific role that all of these things play in terms of international trade between the two largest economies in the world, in the U.S. and China. So we're going to talk about those things with a particular viewpoint on how that process is changing and why Bitcoin is so critical to build the foundation on, in our opinion. So really excited. That'll be August 28th and 29th, as that tweet shows. Get your tickets if you're local. If you're in Southeast Asia, anywhere, come over to Hong Kong and see what this conference is all about. It'll be an exciting time.
Yeah, it sounds amazing. You've been a bit of a world traveler. So you're planning to spend some time there to see the sites, and you're not just business?
Yeah, I'll make use of time. It's as you mentioned, it's summer. This is travel season. Everybody's going to have some time off, including President Xi Jinping in China as well. I think his vacation is scheduled for the first half of August. So it'll be it's a good time to R&R along with getting some work done.
Awesome. Well, great. Well, congrats again, and I look forward to seeing the what you do. I know we've been working on quite a bit of stuff that we can't talk about right now at Build, but we should have some pretty interesting stuff to talk about on the business front there. So great. Well, I know, Matt, I want you to kind of take over and start driving here, but there's a lot going on. I think we had our choice of spin the wheel of what topic. So you wanted to lead off and talk about GDP now forecast. So I will hand it over to you.
Yeah. So I want to get the lay of the land. We're 11 days into Q3, running into the back half of 2025. There's a lot that's starting to develop in terms of some big trends, and we'll get into those in a second. But I think first we want to go through what is actually going on if you take the temperature of the United States economy. And this is where we'll just kind of dive into the crosstabs, if you will, of the Atlanta Fed's GDP Now forecast. It gives a good real-time indicator, and not exactly real-time as in terms of taking the temperature of the U.S. economy. But as new economic data prints come in, they'll update their model. So that's what we're looking at here, row by row. And the things I wanted to go across or go through are first, um, the what's happening with the actual GDP forecast, but then the individual components. And I'll give you a little teaser here to the end. Net exports matters bigly, in the words of President Trump, right? And the tariffs that he's put in place starting in Q2. So you can see those tariffs, the policy shift, really start to take hold in terms of the economic data. So just starting, I numbered the columns at the top in red. I'll talk about each one of those time series as we'll anchor the conversation. This doesn't make for great audio, but if you're tuning in on YouTube, you can follow along with me. So first off, number one, GDP, what's actually happening? We're seeing a slowdown in annualized GDP growth. Um, you see at the top of that kind of red arrow or red pointing down arrow, started at about 3.8% annualized real GDP growth for where this Atlanta Fed model kind of was clocking that number, and that's slowed down from that 3.8 to 2.6. So we're still not in that recessionary territory. That's not exactly a threat right now, I would say, but there is some noticeable slowing. And if you get into the drivers, you start to see a picture uh, that'll kind of define perspective on the things we'll talk about coming up. So number two, the biggest component of the economy now, I'm looking at column two, PCE, personal consumption expenditures. That is just, you, me, other households. We're going out and spending, right? And that's the biggest component of the U.S. economy. It's north of the high end of the 60 percentages, right about 70% of the U.S. economy, and that contribution to economic growth from the consumer is actually slowing down, and that's noticeable here in the data as the Atlanta Fed model updates with every important time series. So started the beginning of the quarter, or May 30th at the top of the spreadsheet here at 2.25% contribution to growth. That's slowed down remarkably. It's now showing just above 1%, 1.08% year over year annualized growth. So as far as the consumer is concerned, this whole engine is slowing down as far as its number one contributor. So that's noticeable. It's going to be a trend to continue to watch because you can't have your number one contributor slow down further and potentially become once you cross over zero, then we're in the recessionary scare type of environment. All right. So for now, the consumer looks like they are holding up. We get some important time series starting next week. I think it is the 17th. We get retail sales data. I'd expect for it to show more of the same now that we have an established trend. But overall, what looks to be happening is the consumer is slowing down. They're tightening their wallets. All right. Next, you get into like the investment side of the economy in terms of equipment. This is not a big sector, but it's a leading indicator of construction projects, real world, like moving earth, that type of stuff. And you see equipment starting to budge as well. That same trend we saw in the consumer, equipment is now, as of like the prints we've seen in Q3, starting on July 2nd with auto sales, you've seen equipment start to show negative growth. So that's stuff like your John Deeres, your Caterpillars, your big yellow and orange machines, right? You see by the side of the freeway that are moving dirt, concrete, et cetera. That part of the economy is slowing down, and then you get into um, construction, right? Non-residential structures and residential investment. You see, and this is column 5 and 6, if you follow with me, labeled at the top of the headers. Those are also slowing down. So Non-residential structures is now negative 0.16% contributor to growth, and residential investment also showing negative with negative 0.27%. So this is the actual things in the economy, like construction workers, housing, building new commercial buildings, industrial, et cetera. That part of the economy is also slowing down. So if you just look at those three things, or like big things, the consumer, equipment, and then structural construction. If you're the FOMC, you are probably watching those things very closely, because the trend is that on those things is not looking good for like the direction of which way those are going. And eventually, what's going to happen if past is prologue, you'll see some policy update to address these things, which means, hey, we're going to ease this, or we're going to stop tightening. We're going to either cut rates or slow down QT or flip QT completely off, since we've talked about in other weekly roundups after the FOMC meeting so far this year. We've basically slowed the QT down to a trickle. We're one more twist of the faucet away from turning that tightening off completely. But if you're one of the policymakers running the show here, these are the things you're probably discussing and watching closely. So eventually, and this is where you get some my perspective here watching fixed income markets. It's not a matter of if, but it's most probable, like it's a matter of when we get these rate cuts. And the other thing I'd add to that is, when you see Donald Trump just like just haranguing over and over again about something he wants done, like it's at the top of his mind, he can't help himself but speak to the media about this thing. We've seen this in the past. Eventually, he's going to keep doing it till he gets his way, right? So these rate cuts, we talk about, Powell finally budging, the FOMC budging. They got, I think it was 3 votes at the last meeting to actually cut rates. It didn't happen. They left them unchanged. But the momentum there is, more committee members voting for rate cuts. And if the data continues to come in as it has, something's, bound to give there. So may not be this meeting coming up on July 30, but it could be. We may get a bit of surprise. So we'll continue to watch those data points as they come in. There's a couple more important ones over the next 2 weeks before the policy meeting takes place. I think it's July 29th and 30th. But these are the trends. They're showing slowdown in the consumer and construction. And those are the things you just can't keep letting happen. Now, you get into where is the growth actually coming from? And this is where things get, particularly important from my point of view. So keep in your mind the dashboard, right? The speedometer right now, according to the Atlanta Fed, estimates that the economy is growing year over year for Q2 at 2.6%. The contribution from net exports is 3.45%, which means net exports is all of the growth and more in the U.S. economy. So what does that actually mean? Well, it's the tariff policies actually taking shape. One, with like the direct effect, we're slowing down our imports in the U.S., our foreign produced consumption, and our exports they've slowed down, but they haven't slowed down anywhere near the degree that imports have. So you balance those two things out. Net exports is if we're running a trade deficit, that's actually a detractor from your overall GDP. So the fact that the tariff policies have functionally shrunk that trade deficit equals increased output. And then so you get there from just the direct effect, but then you've got the indirect effect as well with, hey, because we're not, or now the price to buy a foreign produced good has been elevated because of the tariffs. Well, if there's a complementary good or a competitor good for that same import that was, foreign produced before. Well, if I can now make that same purchase, but get it's domestically produced, I'm going to buy that instead. Well, you've also got an indirect effect from that whole consumer shift from the tariffs incentives, shifting away the inclination, right, to buy the foreign good. You're more likely now, just based on the price component of the tariff effect, to buy from a domestic producer, which lifts the other elements inside your economy, like your factory spin up. You're more likely to buy say a U.S. produced auto as opposed to the German BMW, stuff like that. So all of that is taking place. But we're at a point right now where the actual growth in the U.S. economy is more than entirely accounted for by the imports exports effect, which is
Matt,
quite an interesting place.
Is the dollar weakness this year helping to drive net exports as well? You talk about tariffs, but the dollar's way down year to date, right? Shouldn't that encourage export?
It depends. Well, when you look at the dollar, right, and where is it weakening? When you look at the DXY, it's primarily composed of like your large capital markets, developed country economies, right? So it's the euro, it's Japanese yen, British pounds, Swiss francs, and like you add all those up, you've accounted for like 95% of the weight of the DXY index, which is where you've seen the bulk of the weakening. And we talked about this on last week's episode. What was actually the trade dynamics of what's actually mechanically causing that? Those countries don't import that much from the US, like to begin with. So like maybe they would, but they have their own economic growth program situations, right? And also the trade deals, right? So the answer is maybe they haven't like turned off their exports, but yeah, with the weaker dollar, they could in theory acquire their goods cheaper for their own domestic economies. But there's been, kind of a boycott effect to everything Trump has done, right? Orange Man is bad. Don't buy American. You see it with Canada, especially here in Seattle, right? I mean, it felt like in April and May we had a full-on boycott down to tourism in our city. So I'd say there's that effect. But then if you look at like the trade-weighted dollar, countries where the actual imports and exports of goods takes place, right? These are exporting countries like China, and then I'd call China a developed market at this point. But you just sort and descend and you get, further into the emerging markets. That's where the trade weighted dollar is based on. And I would say for those, yeah, they're not going to be imported. Like the dollar is not necessarily weakening to the same degree it has for those developed market currencies. So like that effect really hasn't even showed up yet in U.S. exports from the currency weakening.
Got it. Okay.
Yep. But a continued trend to watch. At this point, the entire U.S. economic growth is dependent on the net exports effect. So that's not something you can maintain forever. Eventually, there will be a policy move to address these trends, and that means something like rate cuts or other programs that we've grown familiar with. They'll have new names this time, what have you, but something like that is most likely on the horizon, in my opinion.
This makes sense. And to round that out, we're talking about the consumer. How long can the consumer hang on? We talked about this a while back, that you think about residential, market soft, prices are still high, rates are elevated, and you see the big home builders what's their behavior right now? They've kept sales up by shrinking their margins and buying down rates. And so when you think about, I like the term you said there, like the consumer's hanging on for now, but there's only so many levers. There's only so many times you can roll your debt into a new credit card. There's only so many times or how much margin a home builder can eat to pay down rates or buy down rates. So let's keep an eye on it. Do we want to go ahead to the next topic?
Yeah, let's get in the weeds on what we're seeing now, right?
Yeah.
We're at an interesting point right now. I talked about the economic slowdown. It implies there's going to be rate cuts, on the front end. Now, if you walk through all the logic here, all the trade flows, everything involved, the one thing that the U.S. does not have at its control, right? We talked about, if you apply tariffs to certain goods, can you replace that import with something you produce in the U.S.? And for most things, the answer is yes. But for some very critical things, that answer is a resounding no. And that's where you get into this kind of subject of 100% import dependent rare earth elements, right? So it's been a hot topic for, 15, 20 years. We've known this day is coming, but I would argue that that time is, when that critical moment hit and the problem became not just apparent, but like urgent, that moment was somewhere in the past, right? And you're seeing, and why is that, right? These rare earths go into, in particular, what they're utilized in as magnets. You need them for essentially 21st century technologies, drones, EVs, semiconductors, electrification, just go down the list. They're going to be critical for any nation state to compete, in the playing field and the remainder of the 21st century. And that gets into this deal we saw this week as we talk about big topic metal. Didn't list them on the screen with the typical posters with the big three things, but if we did, I'd call it like this week was huge for metals. We saw a really interesting public-private, partnership deal between the U.S. Department of Defense and a company based out of California called MP Materials or Mountain Pass Materials. It's based in Mountain Pass, California. We've got a little helicopter view of their mining operation in the background, kind of covered up. But they are, one of the few production projects live in the U.S. that is essentially working on domestic production of these rare earth elements. So the DoD signed on for a $400 million capital commitment. It's going to be a preferred equity investment. They also got warrants in this deal that would allow them to hold up to 15% of the company's equity. They signed up for an offtake commitment agreement, which kind of contractually obligates them to purchase, I want to say it's like 10 years worth of production of these rare earth elements coming out of the Mountain Pass mining site. And if you just think about it, this is a massive signal, in my opinion, of where this is going, right? So
it's become to pause right there. The U.S. Department of Defense doesn't manufacture things, so they're going to that I think is the chain of okay. They're committing to purchase, but that's got to flow to the manufacturers via some other chain, right?
TBD how this develops, but the trend is towards verticalization. What do we mean by that? Well, you think about the defense industry, you've seen consolidation, over the time frame, right, of the post World War II military industrial complex, right? It's gone through these, like it's narrowed down into number of producers. But as far as, which companies are going to now supply the U.S. military with the the drones, the deliveries, all of that it needs. Who knows? Like there may be deals around the corner for that step of the value chains in the future as well. But right now, you start with you can't produce drones, right, or other key finished products, right, finished goods that you need for modern day war, right, without the rare earths in the first place. So you start with getting your supply chains at the base level commodities, and that's what this deal really represented. So this is huge, I think, for the metals industry itself, the mining industry. But I think it's also an acknowledgement. This also is like the rubber hitting the road with fixed income markets as well. And the core constraint, right? At the end of the day, we can print treasuries, we can expand bank balance sheets, but what you can't print is metals, right? You got to acquire those the hard way. You got to pay the iron price to get those in the Game of Thrones lingo. So this is what's coming. It's the first of and what in my mind looks like kind of a new kind of wave in terms of focusing economic production of these critical minerals inside the domestic United States, so that you have kind of guarantee of supply lines that, the last national crises we went through with COVID, we realized a lot of that manufacturing capacity, the industrial capacity, was not within our controls. So learning from the last war, the lessons, if you will, the last crises, this looks like something that'll be a continued trend, to follow in the years and decades ahead.
I think also looking at the regulatory environment is very related to this. One of the big hurdles in the United States, we have a robust regulatory structure, especially environmental, and these types of facilities do have impacts. And my understanding is that other countries like China, they can kind of straight line a little bit and remove some roadblocks to get these kinds of things done. So I think just keep an eye on what's happening in the regulatory space as well, related to these production of rare earths.
Yep.
You want to talk? Oh, go ahead.
We got to have them, so it's going to happen. All right.
Yeah.
Next slide.
Talk about copper.
Yep. Sister story here. So this came out on Wednesday. The Trump administration disclosed that it would be making a 50% tariff on copper imports beginning August 1. And when they say copper, they mean, finished goods like, strung wire, piping, what have you. But they also mean like copper imports. Like it's very broadly defined here. What does this mean? Oh, and copper rallied as well. We'll get into the charts. What's the actual net effect here, right? So the U.S. domestically produces about half of the copper that it requires for its own consumption, and copper is not mission critical just to these new generation of military technologies, but it's also right on that core trend of where all the economic growth is headed, which is electrification, semiconductors, AI, that whole thing. So you can view this policy step as a kind of protective measure to ensure that the U.S. Copper production industry is essentially able to meet the domestic economy's own needs for copper demand, right? So similar to that wake up call where we've been known for a while now, people have been talking about this critical elements problem. Even copper, you've got a national security issue that's being addressed here. It's basically saying, hey, we're going to focus on domestic production of that element as well. So if you were not paying attention this week, it was a huge signal coming across that metals are going to be extremely important, um, and it's something Washington D.C. is taking into consideration and planning for very seriously. So we've known this there's something that needs to happen for a while, but the policy is really starting to um, come out and become realized. I'd say like really starting this week.
And I just advanced the slide to this is the price chart since last 3 years, Matt. So
Yeah.
walk us through, because you saw a huge spike on that news. Like it was something absurd, like a 10% price shock, like immediately.
Yep. So when you think about CPI inflation numbers, right? Inflation in my mind, I try to focus strictly on a definition of monetary expansion or contraction, like the quantity of money sense. But in terms of prices, right? These elements really set the kind of the baseline for your CPI increases or changes in CPI going forward. And if you look at copper, right, we've been in an upward trend for, this goes back, 20, 30 years. But if you look since the bond market petered out at the end of September, October 2022, you've seen copper in an up and to the right move. And we've seen this in, multiple runs at this point. You've got one going on in the first half of 2024, another serious run going on in Q1 of 2025, and Q2 and into this week, we've also seen another one where basically the copper price just goes exponential, right? It's just weekly green candles, like 13 in a row.
Yeah.
And
Well,
this is
what's interesting, there's no kind of call. I guess there are a little bit in the latter half of 2023, but it's either up or down. It's there's no cooling off period, at least not
so
lately.
so what this is telling you, like this is telling you you're at the boundaries of your like constraint as far as copper supplies and the economy, and prices pushing up to that, and then you hit the constraint and then it breaks and then it runs right up into that constraint again and then it breaks and then again. So if you notice here up into the swings, right, where we flip from a positive trend to a bit of a sell-off or retracement, it all it's been going exponential each one, and it lines up extremely well on the Fibonacci's in terms of the measured moves. I won't get into that for people, but this is, in my mind, the metals markets are flashing a warning sign that like this constraint, like as far as the metal is concerned, is your limiting function for economic growth, right? If you try to print more into this, it's not going to work. It will not do the same thing. You won't get the same effects that you had in the 2010s with QE policy. So what do you do here? There's no easy answer, right? These are like long-term imbalances. It takes several years, if not decades, to resolve your capacity problem, right? To spin up a new, Mountain Pass deposit facility for, those rare earths. That takes a long time. They're big, complex projects. Same thing with copper production. Um, and so the only way out is kind of long-term planning. But if you're looking at the behavior on commodities charts, right? What is inflation in the CPI sense? Like it is these actual commodities, these raw inputs at the bottom of your value chain in terms of goods production. So this is something to continue to watch. It looks like this move in copper this week, we hit another one of those key levels, and I would not be surprised if we get a start of another retracement here. But what you're seeing in metals land should be extremely concerning to your fixed income investors, right? Because this is going to define your inflation. If you cut rates into this, do you actually keep up with, CPI that's coming from, what's ultimately your binding constraint to economic growth? I'd say tough luck or good luck for the fixed income, allocations in this. And you see the same thing, Dave, if you want to go to slide number
Yeah.
7,
Yep. Here we are.
silver, same thing, right? I
Yep.
start this ribbon for the upward trending channel and silver prices. It's the same thing since we saw the UK pensions cry uncle at the end of the last hiking cycle, right? We've
Yep.
seen silver continue, higher highs, higher lows. We're hitting another one of those today. Silver was up almost 4% intraday. There's another sign, right? Silver is a key input in your, AI and semiconductors trend. Another, mission critical industry that US has to compete and win at in the 21st century. Again, metals flashing that same signal. And I don't know if
silver's exacerbated a little bit because it has it has something of a monetary premium. Not as much as gold, obviously, but
yeah,
we went. Oh, go ahead.
I don't think that's really the case anymore. I mean, still constitutionally on the books, right? We're on the 1792 silver dollar standard on the books. But I don't know anywhere, like banks are not going to hold silver to reserve. The dollar is not economically defined as, its weight in silver. What is it, 371 and, some change worth of grains. I don't think that's happening.
Yeah, what I'm saying is that the price surges. What tends to happen is that silver, when the price surges, it surges a little bit more than the other commodities historically, and so it can be exacerbated with something like silver.
So you do still have people who treat silver as money and they're silver hoarders. Same thing as gold hoarders. They still treat gold and silver coinage as cash, right? In the old world definition, right? But that silver stacker, I doubt in aggregate are even close to competing with the demand for silver that is coming from the semiconductors industry, right? AI is massive. It's a trend you have to win. So I think I would probably like my base case here. The chip fabs are much more important to what's going on in the in silver and how this situation develops for the years and decades ahead than the silver dollar believers, if you will.
Well,
That's
don't tell
my
Peter
opinion,
Schiff.
but
Don't tell
either
Peter Schiff.
either way, you're seeing a very similar effect to what we're seeing in copper, right? As the green bars, go on a run here and approach the top of the channel. Um, you technically, actually, it hasn't yet. Where silver, it starts to look exponential. So I don't think silver is anywhere near as flashing the health sign warning that copper is, but it's another metal that is giving you that same data point to policymakers in Washington D.C. and then the financial industry in New York, that you've got to solve your metals problem, right? This is at the end of the day, you can't print these things.
Yeah.
Yeah. Okay. So last, we'll get to the dollar. I didn't update with the latest candle, but the dollar bounced this week on strength. So dollar up, metals up, bonds down, Bitcoin up, right? And if you think about Bitcoin as an energy um, driven or anchored commodity, right, as a ledger money, it's right in there with your hard commodities, right? Not your metals, but your energy component. Although you do need semiconductors, so there is some tie in there as well. But we'll get into Bitcoin in a second. But the important the thing I'd mention here, you got a bounce in the dollar. We talked about this last week. If you're looking at the gold flows, right, and the run on the vaults, right, the U.S. Calling delivery from London and Switzerland, right, for physical gold, that effect actually slows down. So you're actually starting to see a strengthening of the dollar in those other, the major developed market currencies, which last week, as I described, if you look at the channel, if we break red, that would be, the Americans continuing to get what they want, call more physical gold, um, et cetera. Everything we talked about last week with that playbook.
Yep.
Or if we stay in that, post 2008 channel, which I represent in the shaded green area, that's what you would want to see if you're the EU, UK, or Switzerland. So far we got that bounce that'll slow down the pace of physical gold deliveries for now. But this is a story we'll just continue to monitor. So you've actually had a bit of a bounce in the dollar this week, in line with the metals. I'd just say surge. This could be the end of a wave, right? And the metals rally. But it's interesting that we saw on the tail end dollar strength, metal strength, Bitcoin strength, all occurring in tandem.
Yeah. And we're not going to get into duration this week, but I think that would be a good follow on to talk through maybe next week, how this is all tying into the action in the bond markets. Matt, you trade bonds all day. It's been interesting. I don't know if we want to go there.
Bonds have just for high level here. We'll talk. It's a good time to talk next week. We didn't break any key levels, but bonds have trended down. They're trading down since basically July 2nd, first trading day of Q3. It's an area to continue to watch. We got a quarterly research poll today sent out to dealers. That's part of the Treasury's QRA process, with questions that specifically highlighted buybacks and the supply that the market, or the demand from the Treasury that the dealers foresee as adequate as far as Treasury buybacks, which means buying old depreciated low coupon debt off of the dealer's books, or basically essentially taking that out of private supply. And then bills capacity. How much more bills capacity do you think we can jam down the throats of the dealers and the industry, or private balance sheets at large? So those two things. That survey hit, I want to say yesterday, Thursday, and notably today we saw a big sell-off in the yield curve, highlighted by an up eight basis points move in the 30-year long bond. So TLT bulls lost one this week. So we'll see in the next few days and weeks ahead if that trend holds. But we'll talk about bonds a little bit more next week. But so far haven't broken any key trend levels.
Got it.
All right.
Well, let's talk about, the big news last couple of days. Bitcoin has broken out. It was testing resistance around that previous ATH all-time high level, 110, 111, and then it broke through, and it broke pretty significantly up to, I think it's trading around 118 right now. So what's the story here?
Yep. Okay. Story is there's buying from somewhere. A lot of it is coming from the U.S. Publicly traded ETFs, but just zooming out, what is this rally? How do we place it in context? And how I frame this, right? Bitcoin is just think about it as a shiny object that human beings are going through discovering. If you just read the chart here, what does the chart actually show? Financial assets, right, and how they develop, right, how they trade, is a good kind of realization, manifestation, if you will, of collective psychology. And what do I mean by that, right? It reflects adoption, but it also reflects all of the human emotion, right, that we're going through in our treatment of this, how we view this shiny object. So if you look at the chart on the background here, just I'm going to set some context. I started a ribbon here with a trading channel starting with the 2017 December cycle peak. This was the peak retail phase, right? ICO boom, peak altcoining essentially. And if you remember back at Christmas or Thanksgiving 2020, or sorry, 2017 with your
17.
family, it was peak euphoria for the crypto bros, right? I don't know. Like if you look at the top of that ribbon and then you draw the trend line, to set the upper bounds of that channel with the 2021 first peak of the post-COVID stimulus cycle. I'd say those two kind of moments of mass euphoria around, you could say crypto, but really what this thing is Bitcoin, right? The rest is just confusion, in my opinion. Those two, like if you use those two tops as your kind of assessment of peak euphoria for this, our infatuation with this shiny object, right? We've never been back there, right? As far as like the stirring up of the bees or just the humming to that melody, right? We've never hit that top of the channel again. But what's interesting to me, right? We notably had a double top last Bitcoin cycle. You had a peak in early 2021, and then you had another peak in November, right? If you draw the trend line out, and I utilize the log chart here because this thing is compounding at a very high rate. If you draw that trend line and think about that as kind of the lid, it's your resistance, right, for the breakout as human society, right? We're all kind of tapping in and responding to this new thing we're all trying to understand. We've now brushed up and tested that resistance multiple times. Like you can plot them here from the left, like twice at the beginning of 2021, twice at the second half of 2021. We did it last November on the election night results, and then we did it again earlier this year, just before Liberation Day on April 2nd. We did it
Again,
last June. We hit it again back at like 112, and then we did it again this week. And this week was like the first breakout against that resistance line. So if you think about like what does that resistance mean in terms of human psychology, if you try to use this thing as a rough proxy for the hive mind of how society is coming to bits with this thing, we've broken out of that kind of resistance, which to me means you're going to start, you would expect to start seeing a shift, right? It's going to be more euphoric than we've ever been since we were last at that point in Q1 of 2021. So take that behavior, like start to look for this in terms of how people view these things, the questions that people are asked. This is the point where people who might say, "Oh, we were never in," or "I've never been interested in Bitcoin," they'll turn on. They'll be like, "Okay, I should probably start doing something here," or they may say, "Oh, I've been doing this all along," or something like that. But this is where social behaviors will really start to change, is my opinion. So be on the lookout for that, and it'll just be kind of one of those things where, because it is top of mind, you won't be able to avoid it. And we're also like, we're going to start framing things. It'll be that, the man with a hammer, everything looks like a nail, right? This is where you'll just start seeing Bitcoin connected to every dot. It may be things that don't exist, but yeah, this is where the social phenomenon, in my opinion, gets, maybe you can call it weird, but very interesting, right? So
Yeah.
I will not be surprised at all if we start seeing signs of the general public entering some euphoria around this once again.
Yeah, don't be surprised. One thing we talked about offline, Matt, was that sometimes you have these moves and they're so violent that when Bitcoin hit 80,000 just after the election, it didn't it was at 79 and then it was in the 80 range for a hot second. I mean, it just blew through it, and all of a sudden, what the heck is happening? We're in the 90s and hundreds, and so those are the moments I guess I would caution everyone to in life and investing, always just keep a level head. I think a lot of Bitcoin bulls, they like the euphoria. It's obviously it's good if you're a long term holder, but if you're stepping in, you're just getting into it. Just have a plan, come up with a plan, be rational, keep a level head.
They can't.
And
It's
yeah,
impossible. Like if you did, if this is my quote at the beginning that Bitcoin Hong Kong chose to put on for. I don't know
there,
when I
let's
said
go
this.
back. You've had
You've had
plenty of
plenty of
time
time
to
to prepare. Yeah. I don't know. I must
well,
have tweeted that somewhere. Um, but I think it's true. Like whatever happens now, like if you didn't have a plan or you weren't
yeah,
active before, you're just going to start doing things now. It's too late. Like you're just going to be
yeah,
pulled into the gravity um, of just the moment, the euphoria. And if you're late, well, yeah, you had plenty of time. I don't know what else to say. Someone asked me, who is this directed at? Well, really, it's I think about the institutional investor, right? We focus a lot on fixed income allocations. We've been around the world, been especially traveled around the country, talking to institutional investors, pensions, endowments, private investors, family offices, et cetera. There's a lot of adoption going on. A lot of them are in on Bitcoin. They get it. And then there's a lot who just say no. They
yeah,
think you're wrong or,
yeah,
what have you. But that's my point here. Like this is how trades work. Eventually you find out one side wins, either the bulls or the bears and the tug of war. And once the other side lets go of the rope, um, whoever was on the right side of the trade is going to go for a run as, price discovery takes place. And yeah, if if you were on the wrong side of the tug of war who just lost the rope, I feel sorry for you. Um, but I know that this is kind of hollow advice, but this is the chance to check egos, including the bulls, right? Um, stay humble as
yeah,
as our friends remind us constantly. But that's who that comment is really directed at, like
yeah,
pensions, endowments, et cetera. It really is your job description, your duty to be on top of where preservation of capital is flowing, where value is flowing, and achieving those objectives on behalf of people who can't spend their entire working career focusing on asset prices or charts or valuations, et cetera. So yeah, I think that just I'll leave it at that. It's a warm and open invite. If you've been wrong on Bitcoin since 2009, it's a better time than ever to revisit your assumptions and form a new thesis. And but best place to do that is in Hong Kong, August 28th to 29th. You'll kill two birds with one stone. You'll figure out Bitcoin, figure out what you have to do next, and then number two, make some new relationships across the Pacific. I'm talking to U.S. investors here, who is most of our audience, but you'll also be resolving this big transition that's happening within global trade as well as international capital markets at the same time. So, two birds, one stone, get to Hong Kong.
With that, I hope everyone enjoys their upcoming weekend. We're in the teeth of summer now, so it's sunny out here in Seattle, Washington. I think it's pretty much sweltering the rest of the country. So thanks, Matt, for this rundown this week. I think Cameron will be back next week to play host, and we're looking forward to seeing him and hearing about his adventures in the North Atlantic. And yeah, stay humble, stack sats, and have a great weekend, everyone.
Take care.